Good afternoon. Today we're going to be discussing financial forecasting and how it's often used to represent the estimated cost of products or services for a company. This instance is an example of the need to improve forecasting predictions throughout a production process. Mr. Parsi created a financial forecast. However, the end of the month inventory showed a missing inventory worth $350,000. This presentation will show accounts recorded, adjustments, and suggestions to prevent this in the future. As I stated, Mr. Parsi is responsible for financial forecasting. The raw material inventory discrepancy during the inventory report showed a $350,000 discrepancy between forecasting and the raw material used versus the actual material used. This discrepancy does not affect customers as of yet. However, due to such a large discrepancy, the cost of the product may need to increase. The discrepancy, however, does have a negative impact on Parsi and the company as a whole because of the cost of lost revenue. The loss of revenue will also increase the cost for customers in the future and may cause reorganization of processes and departments for the company. Using financial forecasting is a valuable tool as long as the information provided is accurate and up to date. Inventory transactions and the relation to cost of goods sold. Inventory transactions are often recorded as a debit for the inventory that was purchased as raw materials, while a credit is made to the accounts payable. After the manufacture of the product and the selling of the product, a credit is made against the inventory and a recording of the raw materials used, while the cost of goods sold is debited. So in this case, Parsi measured the costs upon the cost of materials. Material costs are often recorded as a journal entry and then into a ledger entry using a T account. This is a description of a journal entry that was made on March 25th showing a supplies expense of $125,000. And it's to recognize the supplies purchased for the month based on 11.22 pounds per unit. This is a T account of the same information showing the beginning purchase of inventory, which is only an example cost because 11.22 pounds doesn't give a dollar amount. Because of the discrepancy, an adjustment to his financial forecast must be made in the journal entries and the T accounts because the actual cost of inventory far exceeded what the forecast showed. So a journal entry and a T account will follow to show the difference. This journal entry at the end of the month on March 31st shows a supplies expense of $470,000. And that's to recognize the supplies used during the period. This shows a T account that has the original $125,000 purchase of materials and then the actual cost of materials at $475,000, leaving a negative balance of $350,000. As again, I said, $125,000 is just a number plugged in because 11.22 pounds would not make this feasible. The effect of the inventory count on the relation of the cost of goods sold. The $350,000 overuse of raw materials will affect the cost of goods sold by creating a negative value for the cost of goods sold. This will lead to an increase in pricing in the future unless a detailed account of the uses is created. As for Parsi's forecast, this has now made Parsi's forecast inaccurate and pretty well void and will create a loss of income for the company. The company loss for the raw material missing or used in production will need to be adjusted in the future. My suggestions to avoid this in the future are a detailed inventory check, an equipment check, and a material check on a completed unit. The inventory check is to actually calculate how much is used during the creation of the product, which will also be the material check on a completed unit. The equipment check is to make sure that the equipment is accurately using the materials, especially if it's a production process. My next suggestion is a corrected amount of raw materials used on each unit in the forecasting and in the journal entries, and a possible increase in pricing of the units according to the actual material used after a detailed account is created. The forecasting was lacking incorrect data, which is detrimental to the company and its current financial status. Correcting the previously mentioned items can help to create a more accurate forecast and to improve the financial state of the company. This will help in the future prevent any errors and hopefully make the company very lucrative. And that today is my explanation of the adjustment account needed and why. Have a great day. Thank you.